Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings monthly conference call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press star 0. I would now like to turn the meeting over to Nick Hamilton. Please go ahead, Mr. Hamilton.
Hi, everyone. Thanks for joining us. Welcome to another monthly Barometer Readings conference call. The goal, as always, is to provide a high degree of transparency on what we're seeing and what we're doing at the portfolio level and what our unique discipline leadership approach is telling us. So since the last call, we've had quite a lot of things occur. We've had our breadth models turn modestly positive since the September attempt at retesting. We've seen some further easing from China and from Europe. So we've had a pretty strong resumption in leadership in the month of October. We're going to spend some time pushing around some of our observations to that end, and as well talk about what held in well, what recovered well, and what degree of massaging we've had to do at the portfolio level. So with me, as always, is our President, Chief Investment Strategist, David Burrows, and I'll turn it over to him to run through the observations on this end.
Hey, folks. Glad to have you on the call today. It's funny. We've had conversations over the years about what you can expect going through different types of market changes and sort of how we go about doing things. And I think that the last 2-3 months has been sort of a bit of a case study. You know that we have had a view that we are in a secular bull market in stocks, specifically in developed consumer-led markets, and that we have had a lot of the characteristics over the last couple of years of what you get in a bull market. You've had a significant shift underlying the economy, which to us is a boom in energy production, providing plentiful and low-priced energy, which is a big win for a consumer economy. You had very low interest rates, and you've had a very slowly improving economic backdrop. In a bull market, you tend to get fairly concentrated leadership, sectors that win in the current environment. And we've had, after the rotation away from energy, consumer sector took over broadly and was very consistent over the last 18 months. U.S. financials have been very consistent. Healthcare had been very consistent. And technology. So 4 key groups that make up a big part of the U.S. stock market. So, of course, U.S. stock market has been an interesting place to be. Canadian stock market, not quite as robust because, of course, we just don't have the same kind of exposure to those sectors. On the other side of the coin, there have been some sectors that, in general, over the last 18 months have been weaker performers, like utilities, like energy, of course, like transports, like really anything to do with commodities. And so, coming into this summer, we had fairly focused portfolios in these areas, and within those areas, there were some very specific names that, for whatever reason, have some secular advantage over their peers, and you've seen some really great outperformance and low correlations within those groups. So we've had a market of haves and have-nots. Within groups, we've had have and have-nots, and being a stock picker, is not a bad thing in that kind of environment. And that tends to be the case in a secular bull market. So, we came into summer and we started to see a little bit of fraying around the edges in the breadth models that we use in world equities, starting in, of course, Asia and Europe, and it worked its way through. And ultimately, the last major market to head lower in breadth was the U.S. stock market. Really, the end of June marked the beginning of the end. And, of course, Canadian market had been under pressure for about a year relative to U.S. So going through the summer, it's interesting because when you look at those sector charts for those key sectors, and I've got them in a deck that I've been using recently, I've got each of those 4 sector ETFs printed to 3 days before that 1,000-point down day in the market in August. And all 4 looked wonderful right up to the end. And, I sometimes cringe the number of times I put some of our slides up on boards talking about how markets go through downturns and how the weakness starts in the weaklings, and ultimately, if the market gets bad enough, it comes back and gets the leaders. And we saw late in August some of the big hedge names start to get whacked, like Disney, for instance, widely held, met expectations, but they didn't meet the hopes, and the stock got beamed. Some of the biotech names started to get hit, and it became clear to us, look, this is one of those times where it's likely to wash through even the leading stocks. So bull markets are marked by steady advances in defined leadership, punctuated by short, sharp declines, that scare the pants off of everybody, make people remember how bad the market can be, and they're over fairly quickly. So interestingly, on the Wednesday, Thursday before that bad day in August, fortunately we noticed that the leaders were getting hit. We put some hedges on in the portfolios, and the various pools held up, very well. If you take the period of August 17th, which marked the top, to ultimately the retest of the lows, September 23rd, the portfolios, I think, gave up anywhere from a quarter to a half of what the market gave up in the decline. So we were pretty happy about that. And so the question always is, where to from here? And some of the things we pointed out on the last conference call were that when the market retested the lows at 1870 in the S&P in September, there were a marked number of groups that did hold lows above their August lows. And that's something we watch for, a divergence, something that behaves better in the second downdraft than it did in the first. And certainly within those groups there were certain stocks that held in better than their sectors. And that's really what we went to focus on. First of all, we wanted to see a retest, and we got it. Second low held. Second thing that's interesting is that the breadth models, specifically starting in the U.S., turned higher in September from lows not seen since 2011. And when we go back and, for instance, look at the decade of the 80s, the percentage of stocks in long-term advances through the course of a decline 4 times got to below 30% in that decade, and every time they got there, felt rotten and the news was bad. And every time that happened and then breadth started to expand, it was time to get positioned. So here we were in September with the same condition, and of course everybody pointed out the 50 reasons why this time it was going to be different and why there could be some black swan event. But the net of it is, we get paid to follow these models. So of course, when the model started to turn up, our job is to try and identify leadership, which can be tricky at times because, of course, when you get market lows, you get 2 types of things rallying. We know that if there is real leadership in the market, it should resume very quickly. So sort of the last groups to break down should be first groups to rally. But that's going to be intermixed with, a bunch of bottom fishing in the junk or the stuff that has been most badly beaten. And, of course, that's exactly what happened. Now, when we look at leadership, you take all of the major sectors, we know that the financials and the consumer stocks in the U.S. had by far the greatest number of securities that diverged away from the market in the group positively through the summer. In other words, their price behavior held up much better than their groups. So those are 2 very clear signs. And of course, consumer and financials, have behaved well off the bottom. They both held above their previous lows, the lows that they made in August, and the relative price performance has been good, specifically in certain groups. So the first thing that I would highlight is that consumer was the biggest weighting we had going into the correction. It is the group that had the most stocks that held up going through the decline. So we came out the other side with a very significant weighting in consumer stocks. And that continues to be good, both consumer discretionary and consumer staples. Consumer discretionary, retail and internet retail, of course, the big leader in that group, Amazon, has, as you know, over the last 10 days, blasted off to make new highs on back of great earnings. When I look at the biggest positions we have as a firm, they include Amazon, Home Depot, Starbucks, all names we've talked about quite extensively. All of them have hit new highs. Lowe's, AutoZone, McDonald's, McDonald's actually a relatively new position. As the market turned higher, screening that group, the McDonald's just stood out, having broken out to a new high almost immediately. And of course, when they reported their earnings, had a great lift. I think there's lots of room to run in that group. Consumer staples like Campbell Soups behaved really well. Some of the leisure and travel companies like Delta Airlines, Royal Caribbean Cruises, of course Disney reestablished leadership, Nike, Electronic Arts. I mean, it's a long list. Sadly, very few in Canada, and we'll talk about Canada in a minute. But obviously, consumer has been one of the strong groups in the Canadian market. So consumer reestablished very quickly. Technology held the secondary low extremely well and started to rally on the back of semiconductors, software companies, networking companies. So companies like NVIDIA in the chips very quickly made new highs on the back of great numbers. Cisco and Microsoft, old tech, big cash flow generators, have behaved really well off the bottom. Google, of course, coming with dynamite numbers. So there's some very clear strongmen in this market that are big, important stocks in the indices. And I guess one of the characteristics we would highlight in this market is that it is the large caps. You know, we've yet to see buying really spread into the mid cap and the small cap stocks. And so, you know, one of the core makeups of the portfolio as they are today is we are very large cap focused, very liquid. And technology and consumer make up big parts of our portfolios. Financials make up a big part of the portfolio. They held quite nicely in the downturn. Secondary lows were higher than the first in August, but probably not everywhere you would expect. Financial technology has probably been our biggest weight. Companies like Visa and MasterCard, Fiserv in the U.S., which sells infrastructure into financial services companies. Total Card Systems, which is a card technology company. And then some insurance like AIG and Sun Life and Progressive. Property and casualty behaved extremely well coming off the lows. So, you know, these groups have shown us very clear leadership going into the decline, very clear leadership coming out. There's some absolute gorillas in those sectors. The numbers are coming out much better than expected. What appeared maybe to be expensive turned out not to be so expensive because the earnings were better than people expected. And then I guess the last group that has been quietly under the surface for us for the last year has been defense. Companies like Northrop Grumman and Lockheed Martin, you know, on the back of spending coming from U.S. government, been very strong, and they've come out very strong also. Now, what didn't come out? We know that healthcare has been a great spot over the last 2 years. It's a group that we had a significant weight in. As we went through the August period, this was the first group that really tipped us off that maybe there was some real weakness coming because some of the big biotech names started to get hit. You know, interesting, Valiant actually held up well through August. And was a name in our portfolio. But a lot of the names got stopped out going through that August period. I mean, as it stands today, we have virtually a zero weight in healthcare because, interestingly, when the market retested the lows in September, healthcare was making significantly lower lows. So there was very clear liquidation going on in this group. Fortunately, in that September period, we came out of Valiant. So I thought I'd talk just about Valiant just for a minute, because healthcare is one group that we're getting a lot of questions about. It was a group that we were focused in. We have almost a zero weight in it today. It's not because fundamentally we see big problems, but there maybe are some questions around the business models. You know, if you think about what it takes to make money in a stock, you got to find, first of all, the asset class has to be the right place to be. Second, you got to find the sector with a tailwind, and certainly biotech and pharma had a tailwind over the last 18 months. Then you want to find a company that has a business model that gives them some kind of advantage, and price doing what it should be doing given what you think you know. And interestingly, you know, I think the last time we bought Valiant was last October, so about a year ago. And, you know, this was at a point where here's a company that was domiciled in a very tax-effective location with a very low cost of debt, meaning they had access to capital. And they had been making acquisitions, buying mature drug companies, cutting out costs like R&D, raising prices, and that's a powerful combination: rising sales, falling costs, rising margins, and a low cost of debt. That was all well and good until Hillary decided to make comments about the fact that some of the drug companies were gouging. And when we started to look into it, it was interesting. We found that some of these companies they were buying, they were raising the price of the drugs by 200% and 300% the day after they closed these transactions. So when that became a political hot potato, that became a fundamental problem. And the stock started to sell off. That calls into question their ability to raise cheap debt. And thank goodness for point-and-figure charts and stop losses. I mean, we entered, I think we started buying it at 120 US, bought it up to about 135. I think it ultimately went to 240 or 50. We got stopped out at 210 on the way down. We actually put up on Twitter, we got a new example finally to replace our Enron chart. But interestingly, you know, the fundamental guys have recommended this stock all the way down. And in fact, I've yet to see a sell recommendation outside of Veritas, which was against the stock for quite some time. But anyway, interestingly, it's just a good example as to how from time to time you have to change your view. And the breadth models turned down on healthcare and you know, really have been sloppy since. And not to say that they can't turn higher, but this is just a group that we had to step away from. As it stands, we really have 4 key leadership groups. All of our breadth models for Canada, for US, for global, for Europe, turned higher. The parts of the market globally that people were most concerned about, you know, could China and emerging markets take down the developed markets? You know, interesting, by September, sentiment for emerging markets was weaker. There were fewer bullish investors by then than there were at the worst point of the Asian currency crisis. And breadth got to the low 20% range. Even the breadth models for emerging markets, Latin America, Asia, have turned higher at this point. So at the margin, they are no longer getting worse. And then, of course, you had a little bit of a bounce in commodities. So going back to the original discussion, you get true leadership going in, true leadership coming out. You're going to get some short covering on the other side. The most vicious bounces came in emerging markets and commodities for about 8 days. And ultimately, over the last week, that initial strength has started to wane. So there really has been no leadership shift. What looked interesting, the bounce in commodities and the Canadian market and emerging markets over the last 7 or 8 days, has really started to wane on a relative basis. We always look at those short covering bounces with suspicion. Let them play out a little bit, see if they hold up. And at this point, it looks like we are headed right back to where we started. You know, weak commodity prices, weak commodity currencies, weak emerging markets relative to strong consumer-led developed economies. When we look at the economic data to say, could we be headed for a recession, which is what the cause of 90% of bear markets. Consumer sentiment is improving steadily. Earnings, when you X out energy, have been coming through this quarter at or a little ahead of expected. The number of pre-announcements coming into quarter was lower than any quarter going back to 2011. Auto sales are coming through at a pace north of 18 million cars. We just don't see evidence that could at all point to recession. Breadth models in the markets that had concerned the market are showing slow improvement. So once again, when we go back to where we're positioned, all of our portfolios are broadly focused in the equity asset class. We believe what we've gone through is a typical bull market correction. Short, sharp, painful, hits lots of stocks, and is over before you know it. We think that it will take time for breadth to improve in this market. But when we look at the seasonality, if you look at the last 30 years, market bottoms in the middle of October, and 75% of the return each year has come in the final 2.5 months of the year. So as we sit today, we are largely fully invested. We're in equities. We are in sectors that were the last ones to break down and the first to turn around and move higher. The individual names that we have in the portfolios are behaving better than their sectors, and their relative strength versus market and their peer group are improving. By a large margin, the companies we own are reporting earnings above expectation, so the numbers are being revised higher. And we have a seasonal tailwind. We continue to be bullish. And we recognize there's lots of things to worry about out there. But in general, these key groups are doing exactly what we would hope them to do, which is to rally nicely. So as far as the pools and the funds go, in general, we're very happy with how this year is going. Excuse me. We have been streaming towards equities. The equity fund is up 9.5%, a little bit more after today. We think that's a good number. That TSX is down 4 or 5%. S&P is just a slight positive. So the balanced fund is up 4% and change. Balanced pool is up about 5%. Long-short pool is up 5.9%. Global macro continues to do well. It's up, as of today, about 12% on the year. The one strategy that continues to be a little frustrating is the income strategy. The income pool is down 3% on the year. Although, since April, the pool has made up a lot of ground versus the peer groups, and has made up a lot of ground relative to market. All of the funds gave up a fraction of the losses that the market had in late summer. And again, I think that we are focused in leadership groups. So the equity fund is about 70% in the U.S. We think outside of the little bounce in the Canadian dollar we saw, which appears to be waning, we want to have U.S. exposure. Technology is 33% of the equity portfolio. Consumer discretionary and staples together make up just under 30% of the portfolio. Financials about 15% of the portfolio. Healthcare now is down at 2.9% of the portfolio. If that were to reemerge, we can always go back. But at this point, we're a little bit cautious. The income portfolio, because it has the income bent, has a lower technology weight. So biggest weight would be consumer discretionary and staples at about 34%. A bigger dividend component there with excellent dividend growth. Financials make up 18% of the portfolio. Technology is 14%. Technology historically has its best quarter in the fourth quarter and certainly is behaving that way now. Energy continues to be extremely low. It's about 3% of the portfolio. That was a small initial weight we bought just in case that followed through. Doesn't appear as it's going to. We have a small bond weight, 3-4% of the portfolio. We're way underweight utilities, underweight telecom. Portfolio is 96% invested. Long-short portfolio, much like the equity portfolio from a sector perspective. Global macro, 30% U.S. technology, 25% consumer discretionary, 16% financials, some various indexes, broad market indexes. And we have reestablished in the last 4 days shorts in energy, emerging markets, and euro and yen. That trade has been a good trade and looks as though it's resuming. So, we're feeling pretty confident that the year is set to finish up well. Coming out of this earnings period, you're going to see a lot of buybacks step back into the market. We know that there has been an incredible amount of bearishness, so there is a lot of cash that needs to be deployed. Hedge funds are woefully behind the market on the year, so there is going to be a performance chase. We know that the number of S&P 500 contracts outstanding in the hands of equity speculators is at virtually zero. So there is no leverage in this market, and people are behind. So I feel good about the fact that we're positioned, and I think that likely you're going to see some people have to chase some numbers through October and November. So if there's any questions, certainly we're happy to answer them. But we would encourage you to use this opportunity as you know, we always talk about when breadth models get narrow, the markets go through corrections and they turn higher. You don't get that many opportunities. Every time it happens, it feels bad. But when you get a significant retest of a low and you're getting now improving breadth, you have the wind at your back. It's probably not a bad time to step on the gas a little bit. And we've done that in our portfolios. I hope that it's useful to you.
Great. Thanks, Dave. So before we get to questions, just a few things I'll wrap up. I think as Dave rightly put, the last number of months has very much served as a case study on a number of things from our perspective as it pertains to not only what a secular bull market correction can look like, feel like, but what we learn by virtue of following what leadership does through that period, how it responds to the correction, when it responds, and how it responds on the rebound. And I think, you know, we highlighted a good example with healthcare behaving differently on the balance and for a variety of factors that helped us put our process into action and exit a group for a variety of reasons. And it should be noted, I mean, healthcare served our portfolios well at earlier points this year, primarily on the straight equity and non-income mandates. On the whole, we've been saying for a while that we have been of the view that with energy's price decline, the consumer groups and a lot of U.S.-centric industry groups should perform well. Often it's a case of really waiting for that leadership and that PE expansion to occur. It looks as though here into Q4 that much of that is starting to play out with performance not only year-to-date being positive on the bulk of our strategies, but month-to-date and even last week was extremely good for us. Anecdotally, it's interesting, the S&P 500 turned positive again this week for the 9th time this year as it flirts with total return and staying positive. Q4 seasonality plays well into our approach as well. Last thing I'll say before questions is please feel free to reach out to your team here, myself, Sarah, and Andrea, for any illustrations that may be useful to use with your investors. We have a number of slides that show our drawdown protection from peak to trough from the period of May 20th to August 24th that are very compelling. And we'd also have some other slides that show when we conduct rotation how that rotation can result in significant outperformance 1, 3, and 5 years out. So with that, we'll open it up to questions.
At this time, if